are assumable mortgage loans? How do they work? Who benefits from those loans? And what are the advantages and disadvantages? Well, today we are going to get those questions answered by my guest, Dirk Hellige. He's a mortgage loan officer with Bank Iowa. Welcome, Dirk.
Hi, how are we all doing today?
I'm excellent, thank you. And thank you for joining me. I really appreciate it. And I'm excited to learn more about how assumable mortgage loans work.
All right, well, that's awesome. Let's get into it.
All right, first, let's start at the beginning. What are assumable mortgage loans?
The easiest way to explain it is a buyer is assuming the seller's loan. So the buyer is basically taking over the loan where the seller left off. So that means they'll take over the rate, they'll take over however many years are left, and the payments, everything. They're just taking it over.
So why would a buyer want to get this sort of a loan?
Well, because most likely the person that's selling the house is going to have an interest rate that could be in the 3s, the 2s, maybe even the 1s. And if a buyer can take advantage of those low interest rates, especially with the rates today being between 6 and 7%, if you can get something at 3 or maybe even less than that, that's awesome.
Agreed. So if the interest rates today, and we're located in Des Moines, Iowa, are let's say 6, and a buyer is going to assume a loan that the seller has for 3%, that means essentially that the buyer's monthly mortgage payments are going to be cut in half.
Basically, yeah, it's super low payment compared to where it would be today if they just bought a non-assumable loan.
Okay. So what types of loans are assumable?
More times than not, the assumable loans are going to be your VA loans, your FHA loans, and your USDA loans. So all the government-backed loans. You're not really going to see it for conventional loans or in-house loans for banks. You're going to see it with FHA, USDA, and VA.
Okay. So a buyer, first step would be find a home that has an assumable loan. And then my next question would be, where do they go for this loan? Can they go anywhere for this loan? And two-part question, are there any certain qualifications that buyer has to have?
Okay, yeah. So the lender is going to have some qualification stuff for the buyer, just like everyone always has qualifications. So, you know, certain credit scores, certain income and debt ratio, there's going to be qualifications. But they're just like the standard qualifications for all loans. It's nothing unique, just standard, have to qualify for this loan. And then as far as they have to make a down payment, right? That's the big part is they have to get their loan size down. Well, they have to, so the purchase price has to get down into the loan size. They have to make a big down payment. Okay.
And so can they go to a lender of their choice for this loan?
That was the other question you did ask. So they do have to go with the lender that currently holds that loan. So whoever holds the seller's loan currently, they have to use that lender.
Let's talk a little bit about dollars now so that this makes sense. So for example, if a home the buyer finds is $250,000, but the principal balance of the loan that the seller owes is only $200,000, where does that $50,000 come into play?
Well, the buyer has to make a down payment. So most times lenders are going to ask for them to get, just make a down payment of that $50,000 to get to the loan size of 200. But some lenders, and you have to check, this is up to the lender, sometimes you might be able to take out a second loan to help get some of those down payment funds to get to that $200,000 loan size. So most are just going to ask for a down payment of $50,000, but some might allow you to take out that second loan to help you get there. You have to check with that lender. They will tell you what you can do to get there.
Good. What are the costs to do a assumable loan, like say in comparison to a conventional loan?
The costs are going to be pretty similar. I wouldn't say they're going to be necessarily like really low. compared to a normal mortgage loan, it's going to be pretty similar. But I would say your costs are going to be a little bit less, but I wouldn't anticipate anything like significantly less. So you will save a little bit of money on the purchase, but I wouldn't say like you're going to save thousands of dollars or anything like that. I'd say, you might save a few $100s on the purchase.
Okay, well, a few $100s is good.
Yep, money's money.
Why not?
Yeah.
Does the lender usually order an appraisal on this
Yes.
type of loan?
Yeah, they're going to order some form of valuation or some way to find the value because they want to make sure, on their due diligence that the sales price matches the appraised value.
So we know that the costs are going to be a little bit less than conventional. We know what type of loans can be assumable, which is the government-backed loans, the FHA, VA, USDA. The interest rate is going to be a lot more attractive than the current interest rate. And the difference between the list price and what the seller owes on the home, that can be either paid in cash or it could be, they could get a second loan for that, right?
Correct. Yep. If the lender says okay, yes.
All right. So then my next question would be, what is the timing of getting a loan like this? Does it take a long time?
I'd say it's pretty close to what the standard time is for a home purchase. Typically, when you're looking at government loans, that means closing timeframes anywhere between 35 to 45 days. Assumable loans haven't been popular in the last decade or so. So now that they're becoming popular, I'm guessing all these banks and their assumable loan departments are getting a little busier than they normally are. So you just got to account for that. It's going to be a little bit slower than maybe a standard purchase, or maybe it's the same speed, but I would anticipate 35 to 45 days on average.
Okay. So this is good information for realtors to know so that they can manage the expectations of both the buyer and the seller, as well as if there's another transaction banking on this one closing, so that we know the timing's going to be the 30 to 60 days, and to obviously check with that lender and know exactly a better price, better timing, so that you know exactly what to expect from that lender.
That's right.
So we've talked about buyers and how that can benefit a buyer in today's market. Let's switch gears and go to sellers now.
Sure.
Is it a good idea for a seller to offer that to a buyer?
Oh yeah, it's a great deal. So I mean, let's just put this scenario out there, because there were VA loans written in 2020 for interest rates, between 1.75 and 1.875%. So think about if someone had a house that they wanted to sell, let's say as a veteran or someone that has a VA loan.
Mm-hmm.
And they have a house they want to sell and they have a 1.75% interest rate on that house. Who in this market, looking at that price point, wouldn't want that? You will be the most attractive house at the price point in the marketplace if you can offer something like that. So yeah, it's a big selling point for the sellers, just because it's such a great rate you can offer, and not a lot of people can. So yeah, it's really good, and there's no reason not to.
I can see where it would be a wonderful marketing tool for a seller in this, market conditions. The environment of the higher interest rates are slowing down the buyers that are in the market, and it's increasing the inventory for the sellers. So if you can offer an advantage for a buyer to assume a loan at a lower interest rate, you could probably get your home sold a lot faster than the house down the street.
Yeah.
How do buyers find these homes that have assumable loans?
The hope is that the listing agent who's helping the seller will ask these questions up front to the seller when they're getting ready to list, and just ask, do you have an assumable loan? A lot of listing agents need to be asking their sellers that question. Because if they're not, they can be missing out on a big opportunity. So if the listing agent knows that it's an assumable loan, then they can put on all their marketing pieces on Zillow or Flyers or whatever, Realtor.com, all the places that list the home, and they can put that in the description that there's an assumable loan eligible. So yeah, that's the best way to find out. I mean, other than that, if it's not, and because some agents might not know about assumable loans, and sellers might not either.
Right.
But if a buyer goes and checks out a house that they like, the buyer can also ask, like, hey, ask the listing agent, hey, do you know if this is an assumable loan or it could be? And then, the seller just has to hop on the phone with the lender and ask. It's a simple yes and no.
So I think we have pretty much discussed the advantages for both buyer and seller. And now let's talk about disadvantages. Are there any disadvantages? I guess we could take the buyer side first. What would be a disadvantage to a buyer to get this kind of loan?
Just how easy the assumable lender is to work with. Because let's say you get pre-approved with a good lender, well, once you get an assumable loan, that's thrown out the window because that lender most likely can't help anymore because you have to use the lender that holds the loan. So you don't know how great a service that they're going to offer. And also you don't know how strict they are with their lending rules. Maybe, so let's use our example before, a $250,000 house and assumable loans $200,000. What if that lender says you have to put down $50,000, but the buyer only has 5% to put down? So, and that's not 50,000. So, and then that lender for the assumable loan doesn't allow them to take out a second loan, then, hey, nothing you can do on that. They can't assume it. That doesn't mean they can't buy the house. Use the assumable loan. Because they can still buy the house, put 5% down and go with today's interest rates. But
sure.
That's the hard part, is if the assumable lender is not willing to help get you there to get to that loan size, that can be really difficult. And you might just have to buy it for the current interest rates today and not assume it. But I'd say that's the biggest struggle for buyers, is you just don't know what the assumable loan lender is going to allow.
Okay.
How easy that's going to be.
Yep. Okay, so I definitely see that. The other thing that I could see is that slight disadvantage, but that same 50,000, if you can get a second loan, that 50,000 is not going to be at the 1% or 2% rate. It's going to be at the current interest rates, right?
Right, it is. But it's still, in the grand scheme of things, the payment's still going to end up being less because the bulk of the loan is on that low interest rate. And you're just taking out a small loan. So even if a buyer does have to take that higher rate on the smaller loan, the overall monthly payment's still going to be significantly less than what would have been the whole loan under that high interest rate.
Yes, I can understand that. So for sellers, what would be a disadvantage for a seller, having a buyer assume their loan?
Well, there's really not much for the seller. They know the lender that's working with the buyer, so they have that peace of mind that someone already has loans helping them. So honestly, for a seller side, there's really not much of a disadvantage. I don't know of one that off my head is like, whoa, that's a disadvantage. No, it's for the seller, it's all good. I guess one disadvantage is, timing, right? So because if you have a conventional buyer, that can't assume the loan for whatever reason, but they can still, conventional loan people can put down, a smaller down payment. They can get the loan closed in less than 30 days. So I guess the disadvantage of someone on the assumption would be it might take a little bit longer. But other than that, not a disadvantage.
Well, the only thing that I could see that might be a disadvantage is if the paperwork documentation isn't done correctly. I mean, the buyer's assuming, if I were the seller, is assuming my loan. And I'd want to make sure that that documentation is done correctly so that if for some reason they default in the future, my lender can't come back to me and say, oh, you're responsible for, paying off this loan.
Nice thing about Iowa is we have that title insurance to pretty much guarantee if there were any mistakes made, that would be covered by them. So hopefully that won't happen, but you're still at the end of the day, you're still leaving it in someone else's hands and ensuring that they can get it done the way it's supposed to. Just like all loan processes, they're always leaving something in someone else's hands to take care of. But the title insurance is going to help give that peace of mind that everything's going to work out okay. There's not going to be anything missed. But, everyone's going to have that in the back of their head that, hey, these aren't typical things that people do. It doesn't happen a lot. Could be more room for error. Yeah, that's probably true. But, most likely it's probably going to be okay.
Okay. And then one other thought that I had before we wrap up is, especially for VA loans, the seller that has a buyer assume their VA loan, are they still able to go out and purchase another home with their VA eligibility, or do they lose that?
Once that home is sold and closed, they right when that home closes, they have their VA eligibility back. So, most people who have to sell first to buy, literally the VA person will close on their home sale first, and then right after that same day they'll close on their new house because they'll have their VA authority back right when it closes. So yeah, you'll get that back once it closes. And then on the other side, just so you know, the buyer doesn't have to qualify for a VA loan. So they don't have to be, when I say that, they don't have to be a veteran, active duty, or a service member of some type to get and assume the VA loan. They can just be any buyer can assume a VA loan, basically.
Wow. Well, this has been excellent information, Dirk. I really appreciate it. And I can see, this information getting out to both buyers and sellers in the current market environment. This makes a buyer just, if they're savvy enough to know about buy downs, they could create great opportunity for themselves right now.
Yeah.
And sellers, if they're aware that they can get their loan assumed, or they can offer that to the buyer, they could really make their house stand out in today's market when there's less buyers out there. So for both buyers and sellers, it could be a great opportunity.
Yeah, if you're a seller, if you're going to be a seller, or you already are a seller in today's market, and you have a VA, FHA, or USDA loan, you need to call your lender and just make sure it's assumable. Just call them now and find out. And then if it is, great, you can market that.
Great. Well, thank you, Dirk. I really appreciate your information. Very helpful. And if anybody wants to talk more to Dirk, have any questions for him, his information is going to be below, as well as mine. So if you have any questions for me, I'd love to talk with you.
All right. Thanks, Michelle.